Now let's go into our third gamma level, which is the high volatility level, or HVL. The HVL is our transition zone, and that signals a shift in gamma regime from positive to negative, or vice versa. It's derived from the inflection point in the slope of the cumulative gamma exposure curve. So the yellow curve that you see there, that's when we see the inflection point. So what does that mean? Above the HVL, we are in a positive gamma environment. So again, a dealer hedge against price movement, which really helps stabilize price action. Below the HVL, we are in kind of like a negative gamma environment. And again, dealers hedge with price movement, amplifying volatility. So why does it matter? Because if the price is kind of like above the HVL, you are more likely to see mean-reverting environment. If the price is below the HVL, you are more likely to see momentum-driven setups, breakout strategies, and so on. Traders can use the HVL level to adapt their strategy, understand if flow is likely to stabilize or accelerate, and again, use them as risk management tool as well. So why is the HVL so important? Because it's really like a sentiment indicator. It doesn't just tell you where the price may react, but it tells you how the price is likely to behave in the current gamma regime. So very, very important. So again, let's look at some scenarios as well on how you can use the HVL. So if we are in a positive gamma environment and price trades above the HVL with a positive gamma regime, dealers are long gamma, which means that their delta exposure changes slower than if they were in a negative gamma environment. As a result, they hedge against price movements, selling as price rises and buying as price falls. And this creates a dampening effect on price movement. And this leads to a more stable mean-reverting environment. So in this setup, the HVL normally acts as a level where the price tends to pin. We're going to talk about pin risk. We always talk about it, especially when we are near expiration. So in these scenarios, traders can expect really the market to chop, and we can see maybe short-term reversal, but the HVL really act as a magnet. This is an example that we took from, I think, yesterday or the day before, where again, the price on SPX was chopping all day around the HVL, in this case, the ETS level. So again, you can use this as your scalping tool, as your risk management tool, and again, this is very, very important. This is one scenario. All right. The second scenario, which is also very, very important, is when we are in a breakdown plus a volatility spike at the HVL level. So below the HVL, gamma flips negative. So now dealers are starting to be in a short gamma environment or short gamma regime. So this changes how dealers behave. So they hedge with the price movement. So they sell when the price falls and they buy when the price rises. So this behavior creates a feedback loop that amplifies volatility instead of suppressing it. So as a result, the HVL level becomes kind of like a launchpad for directional moves rather than a pinning zone. So when the price is below the HVL, traders should expect momentum and trend following setups to dominate the market. So again, why? Because dealer hedge with price, increase in volatility, and breakouts and directional moves are more likely. So that means that if the price drops, they sell more. If the price rises, they buy more. This creates a feedback loop, and we're going to see an amplification of volatility. And that's when we see typical momentum days, breakouts and breakdowns. And again, this is a really good example that we took from a few weeks ago. we break the HVL 0 DTs, we went straight down to the HVL, and then we broke down again with a very, very strong momentum. All right, so this is very important. So this is a very key concept. So HVL, or the high vol level, isn't just a level, it's a regime compass. It helps you choose the right type of trade for the current environment. So again, if you are trading futures and you see that we are flipping from positive to negative gamma, then again, that could mean a lot, and that could also help you adjust your strategy, adjust your hedges, and basically manage your risk better with real-time movement.